Every year, thousands of the smartest people in the world sit down with spreadsheets, algorithms, and decades of financial education. And they lose. They lose to inflation. They lose to panic. They lose to each other. And then there is Warren Buffett, a man who grew up in Omaha, Nebraska, who still lives in the same house he bought in 1958, who eats at the same diners, drinks the same cherry Coke, and reads for hours every single day, quietly, methodically, in an office that looks less like the command center of a financial empire and more like the study of a retired school teacher. Most people look at Warren Buffett and assume the answer is genius. They assume there is some towering intelligence at work, some capacity for mathematical abstraction, some ability to see through data that ordinary minds simply cannot replicate. But that is not quite right. Because the people who have sat closest to him, who have watched him make decisions across decades, will tell you something that is both simpler and stranger than genius. They will tell you that what separates Warren Buffett from almost everyone else is not what he does. It is what he refuses to do. And there is one thing, one rule, held quietly and without exception across more than 60 years of investing, that he has never broken.
Most people, when they hear it, will nod and move on. A few will understand it, and fewer still will actually live by it. Welcome to Smart Billionaire Stories. It is the autumn of 1973, and the world is quietly coming apart at its financial seams. The oil embargo has sent shockwaves through the American economy. Inflation is climbing. The stock market, which had spent years rewarding optimism, is now punishing it. The Dow Jones is falling, not gradually, falling in the way that makes people check the numbers twice, then call their brokers, then stop sleeping well. In offices across Wall Street, some of the most educated financial minds of a generation are doing the math and arriving at the same conclusion. Get out. Protect what remains. Wait for the bottom. Wait for the signal. Wait for something that tells you it is safe to return. In Omaha, Warren Buffett is doing something different. He is buying. Not frantically, not with the wide-eyed aggression of someone gambling. Calmly, deliberately. The way a man shops at a hardware store when everything has been marked down 40% and he already knew exactly what he needed before he walked in the door. He was buying shares of the Washington Post Company, a great media institution by any reasonable measure, dominant in its market, protected by the near impossibility of replicating what it had built, run by people of genuine ability. And the market, in its current state of collective despair, was offering it for roughly a quarter of what any rational analysis suggested it was worth. Buffett recognized something in that moment that most of the people around him did not. The business had not changed. The headlines had changed. The mood had changed. The price had changed dramatically. But the business, the actual operating, producing, earning machine underneath all the noise, was the same business it had been 2 years before, when the market was happy to pay 4 times as much for it. He wrote the check, and then he waited. To understand why Warren Buffett did what he did in 1973, and in 1987, and in 2002, and in 2008, and in every other moment when the world seemed to be collapsing around him, you have to go back further. You have to go back to a young man in Omaha who became obsessed, before he was a teenager, with something that most children don't think about at all: the way money behaves over time. He was 11 years old when he bought his first stock.
By the time he was a teenager, he was filing tax returns on the income from his paper routes, keeping meticulous records, thinking in terms that most adults around him weren't quite thinking in yet. Not because he was told to, because something in the structure of compounding, the idea that a dollar, properly placed, doesn't just stay a dollar, but becomes something larger, and then larger still, had lodged itself in his mind and refused to leave. He went to the University of Nebraska, then to Columbia Business School, where he studied under Benjamin Graham, the man who would become the most important intellectual influence of his life. Graham taught him something that sounded simple and proved to be revolutionary. The stock market is not a mechanism for determining what a company is worth. It is a mechanism for reflecting what people feel about a company on any given day. Those are different things. They are profoundly, consequentially different things. And most people, then and now, spend their entire investing lives confusing one for the other. Buffett took this idea and he carried it with him. He turned it over. He stress-tested it against reality year after year, watching markets rise and fall, watching the gap between what things cost and what things were actually worth open and close with the rhythm of human emotion. And somewhere in those years, a pattern began to emerge. Not just in the market, but in the behavior of the people participating in it.
What Buffett noticed was this. Most people make decisions based on what other people are doing. Not because they are foolish, because they are human. When the market rises, it creates a kind of social proof. If everyone is buying, the implicit argument is that buying must be correct. To stand apart from that, to look at rising prices and feel caution rather than excitement, requires a psychological effort that most people find genuinely difficult to sustain. And when the market falls, the reverse takes hold. The social proof runs the other direction. If everyone is selling, staying calm looks like denial, like stubbornness, like the failure to appreciate how serious things have become. Buffett watched this dynamic operate again and again at every scale. He watched it in small companies and large ones. He watched it during brief corrections and during genuine crises. He watched it affect ordinary investors, and he watched it affect professionals, people with every analytical tool available, with teams of researchers and decades of experience. And he saw that the pattern held. The crowd moved together. The crowd was almost always late. And the crowd, by the time it had fully committed to any direction, was usually already wrong. He also noticed something quieter, something that was harder to see, but more important.
The people who maintained their independence, who had developed, through genuine effort and honest thinking, their own view of what something was worth, and who were willing to hold that view even when the crowd disagreed, those people, over time, did extraordinary things. Not because they were always right. They weren't. No one is always right. But because their errors were random, distributed across individual situations, correctable. Whereas the errors of the crowd followers were systematic. They were concentrated exactly at the moments of maximum danger, when prices were highest, when risks were greatest, when the distance between what things cost and what things were worth had stretched to its most extreme. There was a rule forming in the mind of Warren Buffett. He wouldn't have stated it yet. It was still taking shape in the accumulation of evidence, in the texture of decisions made and avoided, in the slow building of a career. But it was there.
The 1960s were a complicated time to have the kind of mind that Warren Buffett had. The market was generous. The post-war economy had delivered decades of growth, and the financial world was in the grip of a particular kind of euphoria.
The kind that arrives when everything has gone well for long enough that people begin to believe everything will always go well. Investment managers were being celebrated like athletes. There were men running money who had generated extraordinary returns in the preceding years, and they were treated with the reverence typically reserved for oracle-like beings. They appeared on magazine covers. They attracted capital from institutions and individuals alike, promising that what had worked so far would continue working, only faster. Buffett watched this with a particular quality of attention. He saw the logic being stretched. He saw the prices of companies disconnecting from anything he could justify through honest analysis. He saw a market that was being driven less by what businesses were producing and more by what investors believed other investors would pay tomorrow. That is a different game entirely. It is a game where you are not trying to understand businesses. You are trying to understand crowds. And the problem with crowds, the deep structural problem, is that crowds are not rational in aggregate, no matter how rational their individual members might be. Crowds are emotional. Crowds are contagious. Crowds amplify whatever is already happening. Buffett did something that at the time looked strange. In 1969, at the height of a roaring market, he dissolved his investment partnership. He returned the money to his investors. He told them plainly that he could not find investments that met his standards at the prices available in the current market, that he would not lower his standards simply because the market had made it difficult to meet them. The people around him thought he was being overcautious. Some thought he was making a mistake.
2 years later, the market fell sharply. The celebrated managers, the ones on the magazine covers, the ones who had stretched their logic to accommodate whatever prices the market was willing to offer, many of them suffered badly. Buffett had been in cash. And then, when the prices fell to levels he recognized, when the distance between what things cost and what they were actually worth had finally compressed into something that made sense, he began, quietly and deliberately, to buy. It was a rule about restraint, but it was not passive restraint. It was active, deliberate, the product of extraordinary mental discipline applied consistently across conditions that would have broken most people's resolve. To understand what this rule required in practice, consider what it meant to hold it through the autumn of 2008. The financial crisis of 2008 was not a slow unraveling. It was an earthquake. Institutions that had existed for a century were disappearing in weeks. The credit markets, the plumbing of the entire global economy, were seizing. Stocks were falling at rates that hadn't been seen in a generation, and the narratives being constructed around these events were apocalyptic in their scale and conviction. Serious people, not panicking amateurs, but experienced, credentialed, deeply informed professionals, were genuinely uncertain whether the system would survive in recognizable form. The mood was not pessimism, it was closer to terror. In the middle of all of that, Warren Buffett wrote an op-ed for the New York Times. The title was simple: Buy American. I am. He was not being provocative. He was not trying to project false confidence or manufacture calm for the benefit of the market. He was being direct about something he had concluded through his own analysis, using his own framework, in full awareness of the fear surrounding him. The businesses he owned had not stopped producing value. The great American companies, the ones with durable competitive advantages, with products people needed, with economics that had proven themselves across multiple cycles, those businesses were not destroyed by the financial crisis. Their prices had collapsed. Their underlying operations had not. And the prices being offered in the autumn of 2008 for businesses of genuine quality were prices that his framework told him clearly represented extraordinary value. So he bought. Not with bravado, not with a performance of calm designed to impress observers, but because his own thinking led him there, and because his rule required him to follow his own thinking, rather than the emotional weather of the moment.
There is a version of this story that makes Warren Buffett sound like a machine, like something that processes information without feeling the weight of it. That would be inaccurate. The people who have known him longest are clear on this point. Buffett feels what everyone feels: the anxiety of uncertain times, the weight of decisions that involve enormous sums and real consequences, the natural human pull toward the safety of consensus, toward the comfort of acting the way everyone else is acting, so that if things go wrong, at least you went wrong with company. What is different about him is not the absence of those feelings. It is that he developed, over years of deliberate practice, the ability to notice those feelings without obeying them. He learned to recognize the sensation of crowd-induced pressure, the feeling that something must be done, that action is required, that the situation demands response, and to treat that feeling as data rather than instruction, as a signal that the market was in the grip of emotion, which was interesting information, rather than a command that he should act in kind. This is the work. This is the part of the Buffett story that the short versions leave out because it doesn't photograph well and it doesn't fit into a quote. The work is the daily, unglamorous practice of sitting with uncertainty and not reaching for the nearest available action just to relieve the discomfort of it.
It looks like reading. It looks like thinking. It looks like a man in a quiet office in Omaha, surrounded by papers, doing something that from the outside resembles very little. From the inside, it is the construction of an independent view, brick by brick, document by document, question by question. A view that is genuinely his, that can survive the pressure of the crowd's disagreement, that holds together not because the crowd agrees, but because the logic is sound. Consider what Buffett did not do during the technology boom of the late 1990s. The numbers being generated by technology companies during those years were not modest. They were staggering. Companies with no earnings, and in some cases no revenue, were trading at valuations that would have seemed like science fiction a decade earlier. And the argument, made seriously by intelligent people, was that the old frameworks didn't apply, that this was a new economy, that the metrics used to value the old world were simply not adequate to capture what the new world was becoming. Buffett did not buy into it. Not because he failed to understand technology. He understood it well enough to see that some of it would indeed be transformative, that the internet would change commerce and communication and information in ways that were genuinely difficult to overstate. But understanding that a technology will change the world is a different thing from knowing how to price it. And the prices being asked for technology companies in 1999 and 2000 required not just optimism about the future, but a kind of faith that no rigorous analysis could justify. He had a phrase for it, borrowed from the world of sports: the too hard pile. Problems that were genuinely too difficult to solve with confidence, placed to the side, not because the problem was uninteresting, but because the margin of error was too large, because the uncertainty was too great to commit real capital on the basis of analysis that could honestly be described as guesswork, dressed up in the language of investment.
While the technology boom raged, Buffett focused on what he knew: insurance businesses, consumer brands, companies that had been doing essentially the same thing for decades and would likely be doing it for decades more. Things that could be understood completely, evaluated honestly, and held patiently. While the crowd chased the new, he stayed with the knowable. He underperformed the market during those years,
the gap was significant. The commentary around him shifted from the usual reverence to something closer to polite questioning. Was he too old? Had the world moved past him? Had he missed the most important economic transformation of his lifetime? He acknowledged the questions. He didn't seem particularly troubled by them. Then came the unwinding. When the technology bubble burst in 2000 and the years that followed, the losses were historic in their scale. Fortunes that had taken years to build on paper vanished in months. The fund managers who had ridden the wave up were now riding it down, and for many of them, the careers that the boom had made famous did not survive. Buffett's holdings, those boring, unglamorous, old economy businesses, held. Not perfectly, not without volatility, but they held in the way that things hold when they were built on something real. The distance between his results and the market's results during those years was enormous. Not because he had predicted the crash. He hadn't, not with any specificity. But because the rule had protected him from the conditions that made the crash so devastating for everyone else. He had not bought what he could not value. He had not paid prices that required him to believe in things he could not verify. He had not followed the crowd to the edge of the cliff.
There is a concept that Buffett has returned to in different forms over many decades. He describes it as the inner scorecard versus the outer scorecard. Most people, he has observed, live by the outer scorecard. They measure themselves by what the world can see, by what the crowd approves of, by whether their decisions look correct to observers, whether they can be defended in public, whether they fit the pattern of what sophisticated people are currently doing. The inner scorecard is different. It asks a single question. Is this actually right? Not right in the sense of popular, not right in the sense of fashionable or defensible, or what any reasonable person in my position would do. Right in the sense of honest. Right in the sense of, if I did this same analysis in complete privacy, knowing that no one would ever see the result, would I still reach this conclusion? The outer scorecard is not a bad instrument for navigating social life. Many of its signals are genuinely useful. Consensus often reflects accumulated wisdom, and ignoring all of it would be its own kind of foolishness. But in investing, in the specific, high-stakes business of allocating capital across time, the outer scorecard is dangerous. Because the outer scorecard is calibrated to what the crowd is doing, and the crowd's timing is reliably wrong in exactly the moments that matter most often. Buffett built his career on the inner scorecard. It meant being willing to look foolish, to underperform in ways that were visible and public and discussed, to be the person in the room who was not doing what everyone else was doing, and to do that without the comfort of knowing in advance that he was right.
That is a particular kind of courage. It is not the dramatic kind, not the courage of a battlefield or a burning building. It is quieter, and in some ways harder, because it operates without witnesses, without the adrenaline of a clear emergency, without the social validation that comes from acting in ways that others can see and approve. It is the courage to trust your own thinking when the world's collective opinion says you have it wrong.
The decades accumulate in a Buffett story the way interest accumulates in a compound account. Slowly at first, then with increasing velocity, then with a force that seems, looking back, almost inevitable, though it never felt that way from inside the decisions. The investments he made in those early years, the businesses bought quietly, at prices the market was not yet willing to defend, in moments when the crowd was moving in the opposite direction, those investments became the foundation of something extraordinary. Not because each individual decision was perfect. Some were wrong. Some took far longer than expected to prove their worth.
Some businesses that looked durable turned out to be more fragile than his analysis had suggested. But the pattern held. Over and over, across different industries and different economic conditions and different chapters of American and global history, the discipline of the rule compounded its advantage. Every time the crowd overreacted, he had the capacity to respond calmly. Every time prices fell to levels that his framework told him were attractive, he had the resources and, crucially, the emotional stability to act. Every time the noise became overwhelming and the pressure to follow the herd became intense, the rule held. And the holding of the rule over 60 years is not a minor statistical footnote. It is the difference between a good investor and a historic one.
There is a moment in the story of any investor that functions as a test. Not a test of intelligence, not a test of access to information or quality of analysis, a test of character. It is the moment when everything you believe is most loudly contradicted by everything the world is doing. When your portfolio is underperforming and the commentary is unkind, and the people you respect are invested in things you've declined to touch, and those things are delivering extraordinary returns. And the simplest, most human response would be to say, perhaps I've been wrong. Perhaps it's time to adjust. Perhaps the framework that has served me needs to be updated to reflect a world I haven't fully understood. Buffett faced that test multiple times. He faced it at the end of the 1990s, when the technology boom made his results look antiquated. He faced it in the mid-1970s, when the market's prolonged decline made his buying look reckless. He faced it in 2008, when the world's financial architecture appeared to be collapsing, and the most experienced voices in the room were not sure the bottom had been reached. Each time, he passed the test. Not by being certain. Certainty was never the point. He was not certain. No one is ever certain.
He passed by being honest, by going back to the foundation of the rule and asking with as much rigor and as little self-deception as he could manage, does my analysis still hold? Is there a genuine error in my thinking? Or is there only the pressure of being different? If there was a genuine error, he would correct it. He always corrected genuine errors. That was part of the discipline too. The willingness to be wrong in the small ways that protect you from being catastrophically wrong in the large ones. But if the analysis held, and what had changed was only the crowd's opinion of it, then he stayed. He stayed, and he let time do what time does.
The most common misunderstanding of Warren Buffett's approach is that it is about patience alone. Patience is part of it, but patience without a foundation is just waiting, and waiting is not a strategy. What makes the patience possible, what gives it substance and direction, is the rule, the commitment to independent analysis, the refusal to be moved by anything other than honest thinking about real value. Without the rule, patience is just stubbornness. A person who holds a bad position through a long decline is not patient in the Buffett sense. They are simply unable to admit error. The rule is what distinguishes productive patience from destructive inertia. It says, stay when your analysis tells you to stay. Move when your analysis tells you to move. And do not let the crowd's opinion substitute for either. That is an extraordinarily demanding standard. It requires the construction of genuine analytical capability, the kind that comes only from sustained, serious study of how businesses work, how they generate value, how they deteriorate, and what distinguishes the ones that last from the ones that don't. It requires emotional self-awareness of a high order, the ability to notice your own reactions, to trace them back to their sources, to distinguish between an impulse that originates in clear thinking and one that originates in the noise of the moment.
And it requires the rare willingness to be wrong publicly and to absorb that wrongness without letting it destabilize the framework that produced the decision. Very few people can do all three of those things simultaneously, across a career spanning decades, without faltering in a significant way. Warren Buffett, by any reasonable accounting of the evidence, has done them.
The legacy of the rule is not primarily financial. Yes, the numbers are extraordinary. The compound returns generated over more than half a century represent one of the most remarkable financial achievements in recorded history. The wealth created, not just for Buffett, but for the shareholders of Berkshire Hathaway, and through the philanthropy to which he has committed the vast majority of his fortune, is genuinely staggering in its scale. But the legacy of the rule, in its purest form, is not numbers. It is a demonstration. A demonstration that it is possible, not easy, but possible, to navigate the markets of the modern world without being swept into the cycles of collective irrationality that have undone so many people with so much intelligence and so many resources. That the problem is not primarily analytical, it is behavioral. That the gap between what people know and what people do is wider than almost anyone is comfortable admitting. And that the closing of that gap, the alignment of knowledge with action, of understanding with behavior, is the work of a lifetime, not a weekend.
The story of Warren Buffett is, in the end, a story about a single question, asked thousands of times, in thousands of different circumstances, across more than 6 decades of financial history. The question is not, what is the market doing? It is not, what are other smart people doing? It is not, what does the momentum suggest? Or what does the chart show? Or what is the consensus view of the people I respect most? The question, the only question that the rule requires, is, what do I actually think? Not what does the crowd think? Not what would be safe to think? Not what would be defensible if things went wrong? What does the honest application of rigorous analysis, conducted without the distorting influence of social pressure or emotional urgency, actually conclude? That question, asked and answered truthfully, is the rule. And the rule, applied without exception across 60 years of one of the most volatile, surprising, and consequential markets in history, is the career.
Most people will hear this story and find it interesting. They will appreciate the logic. They will admire the discipline. They will recognize, somewhere in themselves, the truth of what the rule describes. The way crowds move, the way pressure operates, the way the distance between knowing and doing is so much wider than it should be. And then they will go back to the world, and the world will be loud, and the market will move, and the crowd will find its direction. Most people will follow it. A few won't. And in the difference between those two responses, in the gap between the many who understand and the few who actually hold the line, the same story will play out again, as it has always played out, as it will always play out, for as long as human beings are the ones holding the pen. The rule is simple. Living by it is the hardest thing in the world. If you enjoyed this video, make sure to subscribe to Smart Billionaire Stories, because the best lessons are hidden in stories. Thanks for watching.